Hi, I'm Andrew Vierra, branch manager with WealthWise Mortgage Planning and the voice behind VALoansOfCalifornia.com, coming to you from Folsom, California. Today, we're going to talk about the money that is needed to close on a home loan. And in most transactions, we need three buckets of money. Okay, we need down payment, we need closing costs, and we need prepaid expenses. So for the topic that we're talking about here, the VA home loan benefit, we actually are going to assume that you have full entitlement. All right. So if you have full entitlement, then for however much you qualify for financially, you do not need a down payment. So we're going to assume that that bucket goes away for this discussion. Our second bucket of money that we need to close a home loan are called closing costs. And what closing costs are, they're costs that go into putting the loan together. You're basically paying people on your behalf to put the loan together for you. You can think of it like if you had a home and you wanted to add a room to your house, you would go out and you might get a contractor and you're going to find out, how much lumber you're going to need, how much materials you're going to need. You're going to add up all the costs of that. And that's basically the cost to add that room to your house. That's similar to what we call closing costs. All right. So in closing costs, those encompass things like the appraisal on the home and the underwriting fee and maybe processing with the lender. And there's going to be an escrow fee involved, and the escrow company that puts the transaction together on behalf of everybody in the whole transaction, the real estate agents and the seller and the lender, they're the independent third party that puts everything together. They're called an escrow company. So they have a fee involved. There's title insurance to make sure that once you buy the home, or if you're refinancing the home, that you have clear title, meaning that somebody else can't come and make claim on the property after you buy the house. Okay. And then there's going to be a notary that they're going to charge a fee to notarize all the documents. And you're going to have a cost for recording the deed with the county. So the county, they charge a fee to do that. And there's some other ancillary little fees, but you pay those fees one time, putting the loan together. And once you pay those, you're done. So that's a cost to doing the loan. Our third bucket of money, that is for prepaid property taxes, homeowners insurance, and a little bit of interest depending on what time of the month that we close a loan. All right. So the reason we need prepaid property taxes and homeowners insurance is as part of your payment, you pay principal and interest on the loan outstanding, just like you would if you're paying principal and interest on a car loan. In addition to that, there is going to be added 1/12 of the annual property taxes and 1/12 of the annual homeowners insurance. So the lender takes those 1/12 every month as you make those payments, and they set them aside in this account called an impound account or an escrow account. You'll see it on your statement. Usually it's going to say, it'll say either one, impound or escrow. The lender sets those monies aside and they accrue up. And when the bills come due for each of them, so when the bill comes due for property taxes, you receive a copy of the bill, and then a copy of the bill goes to the lender, and then they make that payment on your behalf because they've already collected enough money to do that. But when we close the home loan, and it's determined by a schedule that is set by when property taxes are due in your state. So in California, we have property taxes due twice a year. So there's a schedule that every lender uses. It's the same schedule that says you close your loan on this month, your first payment is due this month, and then it tells us how much money we need to collect in advance based on when your loan closes to how much money for property taxes we have to set aside in this account. All right. So we collect a certain amount of property taxes. And then for homeowners insurance, we're always going to collect 1 year in advance to insure the property plus 2 months. So 14 months that we're going to set aside in this account as well. And then depending on when we close the home in the month, we're going to collect some interest. So if you close the loan on the 15th of the month, then we're going to collect some money for the 15th through the end of the month, the 30th. So the prepaid bucket includes prepaid property taxes, prepaid homeowners insurance, and a little bit of interest. And if there were an HOA involved, we might have to collect some money for that to deposit in this account. All right. So 3 buckets, no down payment for you, closing costs, and prepaid taxes and insurance. Now, the next question becomes, how can this be paid? Because you hear all the time that you can get into a VA home loan with no money down and no costs out of your pocket. but you can see that there are costs involved in a home loan. They're always there. And traditionally, in the old days, if somebody wanted to get into a home with no money out of your pocket, the seller was expected to pay the costs on the veteran's behalf. All right. But let's assume that in a competitive market like we are in now, that the seller is not going to pay those costs for you. You are allowed to pay those costs on your behalf, just like anybody else. All right. It's no big deal. So if you have money saved for closing costs, you have money saved for prepaid taxes. And the question always comes up, how much are those going to be? Well, the closing costs themselves, a lot of the costs are pretty standard. The appraisal is always the same with VA, depending on your state. There's a set cost for that, and the credit report and underwriting and processing. But the title insurance and escrow fee varies with the purchase price on the home. So roughly speaking, I estimate that the closing costs on your side, depending on how you negotiate the contract, are going to be about $3,800 to $4,000. I always round up because we want to be conservative. On the prepaid taxes and insurance, the taxes and insurance are based on the purchase price of the home and the amount of loan when it comes to the insurance. So it's hard to know exactly how much it's going to be, but if you figure about another $3,000 to $4,000, now we're up to $8,000 when you combine those two. You need to ask your lender. Once you're getting qualified, your lender can tell you and give you an estimate about how much money that you're going to need to close. All right. But now we get to, how do I pay that? So you could ask the seller to pay it. You could pay it out of your pocket, or any interested party in a VA loan can contribute to you offsetting some of your costs. So if you have family who wants to give you a gift to help you offset those costs, they can do that. Your realtor can give you money to offset costs. There is a way that you could potentially take a little bit higher interest rate and get a credit from the lender. So the buckets, we said 3 buckets: down payment, closing costs, prepaid taxes and insurance. And there's lots of ways to cover off those costs on your behalf. So I encourage you, give us a call, send us an email if you have questions about any of this. If you're using another lender, talk to your lender, make sure that they're walking through this information for you so that you know exactly where you stand. But it's not as hard as everybody thinks. It doesn't take as much money as everybody thinks. Thank you for watching. I look forward to talking with you soon. Bye-bye.